Hey guys, so everyone's doing their sort of bear market apocalypse videos, so I thought I'd weigh in, but not with the sort of shocked face, crying face in the thumbnail. I thought let's look at some real figures. So, looking at the S&P 500, we're at 3,900, probably going to be about 3,800 something by the end of the day. So that puts us down sort of probably getting on for 20% by the end of the day. So I thought we'd look at sort of history and see if we can use that to see how far we could potentially go down. So this is the S&P 500 all-time PE ratio from Macro Trends, website that I'm very fond of, and yeah, this sort of shows you sort of how low we can get in the bear markets and sort of how high we go sometimes in the bullish times. So sort of going back long-term average, a lot of people would say around about 15 would be the long-term average, but in sort of more recent times we have been a little bit higher, certainly since the sort of start of money printing and that sort of thing, lowering interest rates indefinitely almost. We've sort of probably got to about more of a 20 average, so looking like by the end of the day we could be down to a 20 average, which is interesting. But we've certainly been lower, even sort of in the past couple of decades. We've been down to sort of below 13s. That wasn't at the height of the crash, interestingly, because obviously sort of earnings fell off a cliff during the Great Recession. But yeah, you sort of get periods where earnings will be not too bad and people still not willing to pay the price for the index. And sort of, yeah, even in like mid late 2006, you're getting sort of 16s, 17s. So yeah, it's not uncommon for us to get to sort of a mid-teens PE ratio again. So looking at the index itself compared to the earnings, you can see that it does sort of generally track it somewhat sort of erratically, but yeah, it's not too bad. And interestingly, sort of since the lockdowns and everything, we have actually had earnings increase significantly, even with this sort of bull run that we've had in stocks. It's not sort of necessarily going up on no earnings. The earnings are significantly ahead of pre-lockdown, so yeah, it's not necessarily just bubble territory. This is going up to March 2022. So yeah, looking at sort of $198 in earnings, but comparing to the projections, this is Y charts projection of sort of quarterly earnings, and they've got the current earnings around sort of in the 50s, sort of high 40s. So yeah, you're going to be sort of looking at 200 to 210 in earnings. So potentially sort of a 5% increase in earnings, which is interesting considering sort of the times we're in at the moment. Part of that could just be inflation. But 2023, they're projecting quite a heavy increase in earnings, sort of getting up to $61. So if you sort of add these up, for 2023, they're projecting about $229. So that'd be a sort of good 10% increase in earnings, which a lot of people are sort of predicting a recession coming. If people are still basing their S&P 500 sort of projections on these earnings, then might not be so good. So if you sort of soak 229 for next year, even at the sort of bullish-ish 20 PE, then yeah, you're looking at sort of 4,580. But if we were to sort of come down to say 15, the sort of longer term average, yeah, you could be getting to sort of 3435, which would be sort of another 15% or so even down from here, which 20% down from the top is not generally a bottom in market crashes. So yeah, certainly could happen even with bullish sort of 10% increase in earnings next year. So it's an interesting one. So it's interesting if you look at the US GDP. I'm using US here just because it's sort of representation of the world. And yeah, if you look sort of pre-lockdowns, basically if you extend sort of the GDP trend from there up to sort of October 2021 and then onwards, it's basically an unbroken line, if assuming it all never happened. So we are actually sort of carrying on in GDP, although obviously you've had 7 trillion in dollars printed to sort of get back to this point. So you'd maybe hope that GDP was actually sort of higher than trend. It's basically looking like printed 7 trillion to get us back on track, and now obviously that 7 trillion is going to become an issue. So they're raising interest rates and sort of tightening, trying to sort of reduce that 7 trillion down. So yeah, interesting to sort of see that GDP hasn't exactly gone up compared to where it would have been had there been no lockdowns. Just looking at the interest rate side of things, so this is the 10-year government bond yields. So even without the Fed putting interest rates up, these have been going up significantly. So whether this is people selling off bonds or foreign entities selling off bonds and US institutions selling off, they're sort of unhappy with the yields that they were getting before, and sort of this will really end up forcing the Fed's hand. You wouldn't normally get sort of 3% on that with Fed funds rate as it is. So looking back over sort of the longer periods, a lot of people are suggesting we have sort of ended the long-term trend of sort of falling interest rates. So it almost seemed like every time we had a bear market, sort of the bond yields would then come down. People would sort of buy them as a safety. They would sort of trickle back up again, but they would always come up to a lower high every time, and that's sort of been going on for the last 40 years basically. But if you sort of draw a trend line all the way through this, if we carry on upwards with another sort of 0.5% Fed rise coming on Wednesday, I believe, and then sort of another one next month, probably another one in September, you're adding on 1.5% to the Fed funds rate. We'd expect the sort of 10-year bonds to go up as well, and so yeah, we could be breaking this sort of 40-year trend of falling interest rates and sort of going into a new high interest rate time, which the stock market sort of hasn't seen for obviously a very long while in most of our lifetimes. So this sort of rising interest rate environment isn't going to be particularly healthy for companies with a lot of debt and not really the cash flow to sort of pay that debt off. There are sort of companies with a lot of debt that could potentially sort of pay it down now that rates have gone up, or rates are going up as well. So yeah, companies that have sort of speculatively taken on debt and now are going to have to roll it on to higher rates sort of over the next few years could be in a little bit of trouble. So this is an interesting chart, the S&P 500 versus durable goods orders. So sort of level of manufacturers' new orders for large, costly capital expenditure items, so machinery and factories, property, and that sort of thing. Basically, how they perceive their future business prospects, and yeah, has sort of correlated somewhat with the market over time. Sometimes sort of leading into higher stock prices. Sometimes it lags a little, but yeah. So looking at the sort of lockdown period. Obviously, you had a huge decrease. No one was really spending anything. But then it has come back and hasn't really dropped even through this sort of down period. This goes up to April. Obviously, the market has dropped a little bit more since then, and would be nice to get sort of a little bit more recent durable goods orders data. But yeah, you're still seeing sort of fair rises, certainly sort of a rise since the end of last year, which is somewhat bullish. So yeah, as I say, it'd be nice to get another month or two's worth of this just to see if it's carrying on upwards. But yeah, it's well in excess of pre sort of pandemic levels where we sort of didn't really expect anything bad. So yeah, the fact that they're not really cutting on spending on that sort of thing would be a little bit bullish. And yeah, just looking at inflation being sort of the main thing that's going to lead interest rates really. So this the US CPI and core CPI, so excluding food and energy, core in red, normally a little bit lower than the total. But yeah, you can see we've sort of had periods of very high inflation, sort of in the double digits back in the 70s and 80s, but we've not really seen that for sort of the last 40 years. So to now be getting this is a little bit of a surprise to most investors, and we are still seeing overall inflation going up. They're sort of blaming this still at the moment on the war and on oil, but excluding food and energy, you're still at 6% year on year. That admittedly has been sort of coming down for 2 months now. Wouldn't sort of count my chickens too much on that. This could always spike again. But yeah, so interesting to sort of see core is still fairly high, and we shouldn't be just blaming this on oil and gas. And this is what the US say is the important parts of inflation, basically. So they give the sort of year-on-year change and month-on-month change, but the size of the circle is the importance that they place on each of these. So the chart's been heavily distorted by sort of energy, commodities, and that sort of thing. The chart wouldn't normally go to 50% year on year, but that's what's happened. But they put a very low importance on energy commodities, so it's up 50% year on year, 8% on the month, which isn't particularly good. So not exactly slowing down anytime soon. Energy services 16% up on the year and 3% up on the month. Again, they say very low importance, even less so than the commodities. And then you have sort of slightly more important food at home, up 1.3% on the month and 11.9% on the year. So that's still a fair bit. They have food away from home, so your restaurants and takeaways and all that sort of thing. Less important, but is still up a little. And then the sort of two very important ones, commodities, less food and energy, 0.4% on the month, so not all that bad, but still 8.5% on the year. And then sort of the main contributor to core inflation is the sort of services without energy, so still 0.6% on the month, 5.2% on the year. And they give this a huge importance, sort of pretty much more than all the others put together. So yeah, interesting. So as I say, this sort of chart will sort of distort the usual figures. This sort of looks like very low inflation. That's only because the energies are at 50%. But yeah, even 5.2% year on year is sort of well above the Fed's target. And you would expect, unless this is coming down, then they would continue to be sort of raising interest rates. Like I say, they're still talking about 0.5% in the next 3 meetings at least. But sort of have my doubts as to whether they will do sort of follow through on that, depending on sort of GDP numbers. GDP you have already seen, while this is going up, I think quarterly on quarterly, they had a 1.4% loss in Q1, so that wasn't particularly good. It's not showing on this graph. Yeah, so this shows the GDP a little bit better. So sort of you can see during the 2020 recession, we call it a recession. It was sort of very sharp down and up, but you had 5% negative GDP, and then 31% obviously for the lockdowns, and then roaring back 33%. But we have come back down to a negative Q1 for the US, 1.4% down. So yeah, depending on sort of how the rest of June goes, maybe in sort of mid-July, you could be hearing officially a recession. So it basically brings us back to our forward estimate of earnings. Sort of predicting 10% earnings growth next year, with potentially recession, sort of higher interest rates, inflation may be still an issue, maybe down to sort of 5% inflation next year, which is still higher than the 2% target. Whether they would sort of drop interest rates if that's sort of potentially causing a recession, we'll see. But yeah, not all that sure we would see this sort of projected growth. With markets sort of being forward-looking, they would then be sort of pricing in maybe potentially even a lower multiple on lower earnings. So you sort of get double whammy if you were to potentially sort of get, say, $215 instead of the $229 they're predicting next year, at sort of the more bearish side of sort of 15 times earnings on the longer term average. Yeah, you could be looking at sort of 3,225 compared to the 3,900 that we are now. So yeah, potentially still another 17.5% down. Obviously this isn't, scientific, we're just sort of plucking numbers out of averages through history. But yeah, I think the whole sort of bear market is over, as some people are sort of suggesting, just because some of their stocks are down 70-80%, is not really going to hold water. There's always going to be stocks even early in the bear market that are down 70%, 80%, and that's just because they're not particularly strong companies, or they were sort of basically built for the bull market, and that's not where we are at the moment. So yeah, I think another sort of 15 to 20% down if we do go into a recession and they start lowering these earnings estimates is sort of far from out of the question. And obviously you would expect the sort of NASDAQ, the more sort of speculative tech stocks and that sort of thing, to probably be doing worse in that scenario. And obviously sort of the more speculative things like crypto and sort of anything like peer-to-peer lending and that sort of thing, I could see having a real struggle. But yeah, so thought I'd just have a look, an objective look, without putting too much emotion into it, and see where we could end up. So leave your thoughts in comments below, and like and subscribe. See you soon.